So we can now start. Sorry guys, I've not been able to come to classes for obvious reasons, as I indicated. I'm under house arrest by the doctor, so I was not able to come physically for classes. Now, I was not even able to do Zoom because I was advised not to sit up for too long. I was on complete bed rest. So anyway, I am hoping that we can do maybe 2 or 3 Zoom sessions so that maybe we can, because we don't have a lot of time before we finish. Is everybody able to hear me?
Yeah, from this side I can hear you.
What about John? Can you hear me?
Yes, I
Akim,
can
can
hear
you
you.
hear me? Yes, John.
Yes, I can hear you.
Good. And Akim, you can, eh? Okay. I'm assuming since some can hear me, I'm assuming that a lot of you, as you join in, will be able to hear me. Now, we were talking about financial statements, and we finished talking about financial statements. There are about 3 of them. One is balance sheet. The second one is income statement. The third one is a cash flow, statement of cash flow. So those we discussed what they are composed of last time we met. So today we want to look at one, what are these, how do we use these financial statements? Why are they important? And secondly, how do you analyze them? What kind of analysis you can do from these financial statements? Now, first of all, we should look at why they are there. I think I should try to share the screen if I can. Can you guys see my screen? Hello?
Yes.
Anybody can respond. Are you able to see the screen that I'm sharing?
Yes, it's clear.
Sorry?
Yeah, we're able to see and it's clear.
Yeah, you can, eh?
Yes.
Good. So, why are financial statements important? Why do we have financial statements? That's what I would like to go over again. Now, these financial statements are reports that are made for a purpose. And they are made for different stakeholders information. So they exist to provide useful information on businesses to people who are stakeholders, people who want to know something about these businesses, people who have got a stake in these businesses. So these financial statements provide information so that they help stakeholders to understand more about financial statements, what these financial statements are saying, the financial health of the organization, the performance of the business, the financial health of a business. So for example, we have got various stakeholders. One is investors. So investors use these financial statements so that they can make decisions where they can put their scarce resources, where they can invest their scarce resources. So for investors, this is good information for them to know or to have. The second group of stakeholders is what we call debt suppliers. Those who supply loans, for example, bankers. So they want to see whether a company is credit worthy. The idea is they want to see whether this business can be able to repay back. So there are certain things that they will be looking for in these financial statements that will show that the company will be able, if they give it money, they will be able to pay back. So it determines, or the financial statements will show information that can other people can evaluate and see that this company, if we lend it money, it will pay back. The third group are the suppliers. As you know, some suppliers give out these they give out some goods sometimes on credit. Now, if a supplier is giving you raw materials and says you should pay it within 90 days or within 30 days, it depends on, suppliers have got different policies. So suppliers will not be able to do that if they have little information about your business. So they want to see whether you are a good potential customer and that you are risk-free, that they can give you, they can supply you with certain products or services and you pay later. And then you also have a fourth group, which are your customers. Your customers are the people that you supply things to. So for example, you are, just a stupid example, you are doing a business of, let's say, you are running a school and you want people to be supplying you vegetables every day, fresh vegetables, achina nkwanya or achina cabbage or whatever, fresh supplies every day. You want to see, to be able to see whether this company is strong enough financially or otherwise to be able to supply things on a long term, for example. a year supply, daily supply for the whole year of pumpkin leaves, for example. Your financial statements will show how strong you are financially, how your cash flow is like, and that you'll be able to supply to your customers. So that's category number 4 of stakeholders who will be interested in your financial statements. Number 5, of course, are the tax authorities. The tax authorities, MRA, want to be able to see whether you are paying a fair share of taxes. So they will be interested in looking at your financial statements. In this case, for example, the profit and loss account, which is the income statement, to see whether your figures are a fair representation of your financial status, of your financial health, and that you are paying a fair share of taxes. Then you have another group of stakeholders, which is probably number 6, which are trade unions, trade union representatives. When they are negotiating salary increases, they must be aware of the financial position of the company. So if the company is not making a lot of profit, it would be unreasonable for the trade union representatives to be asking for the company to double their salaries, for example. So these financial statements are a very useful tool for these trade unions leaders when they are negotiating for better packages for their people. And then there's another group of stakeholders, which are basically those you compete with. Those you compete with, competitors, want to see, or you want to see whether you are performing as good as your competitors. So you want to see whether your performance is below par or at the same level, or you are performing exceedingly better than your competitors in the market. So your profit margins, for example, your turnovers, your market share, all that information and data is captured in one of those 3 financial statements. And then you have another group of stakeholders, which are, for example, courts of law. So, for example, unfair trading practices, when they go to court, the court can look at your financial statements and see whether your trading practices are unfair. Or, for example, if there's a damage to your business, how do you claim? What evidence do you have that you have made this damage has caused your company this much loss? The courts will use your financial statements to see what kind of profits you make. So if, for example, a damage to your premises has caused you to close down for 3 days or close down for a month, how do you claim damages for that closure? So your sales, for example, that your financial statements might actually show the sales that you make every month, or the kind of profit that would be affected for you because you have closed down for a month. Okay. And then there's also what we call antitrust regulators. These are similar to what courts of law do. These are about unfair practices, market share, and all that. Monopolies, unfair barriers, normal, above normal profits, and things like that. Then the last group are new employees, prospective employees. So, for example, if you are recruiting for a manager, or you want to recruit new employees, new, capable, and highly sought for employees, you need to show that your company is going to be there for a long time. A company that shows that it can exist for a long time. So some people don't want to go into a company that, you know, is on a shaky ground, that anytime this company can close down, for example. Nobody wants to go and apply for a job in such kind of a situation, in such kind of a company. So these financial statements, prospective employees, serious prospective employees will look at the financial statements of a company before they even try to apply for a job that has been advertised. So these are quite many stakeholders who are interested in looking at your financial statements and how it helps others to evaluate how you are doing, or admire, or look down, depending on their motives. So these financial statements do provide very useful information for a lot of stakeholders. So now these stakeholders will look at various indicators in these financial statements. So each one of them will look at a particular point of I can see that some people who have been admitted, I don't know whether you get in and out. Why do I have to be admitting people all the time? Okay, so far, any question?
Yeah, myself, I didn't get on the first.
So let's speak up. I can't hear you.
Okay, I didn't get on the first use of account information.
I can't hear you. Who
The
is
first
speaking?
stakeholder.
Your volume is very low, my brother.
I didn't get you on the first stakeholder.
The first one,
Yes.
which is what? Investors.
I didn't get it. Yes.
The first one
lost
was
it.
investors.
Okay.
Yeah, so investors, they will be looking at your company or other companies. They have money, so they have to make a decision, for example, which company they should buy shares from. which shares to buy. Should you go and buy shares in Impico? Should you go and buy shares in Nico? Should you go and buy shares in TNM? The decision is based on the financial statements that you can have access to. So for them to make a decision on where to invest their scarce resources, the financial statements help them to make that decision. Are we together?
Yes. Yes.
Okay.
Yeah.
Any other question?
So-
If you have any question.
Is it right to say that and now we are looking at the importance of financial statement to the stakeholders?
What we are looking at is that financial statements provide useful information on companies to people who have got some interest in those companies.
Okay.
So financial statements help people in different ways, stakeholders in different ways. It could be one, investors, it could be bankers, it could be suppliers, it could be customers, it could be MRA, it could be trade unions, it could be your competitors, it could be courts, it could be regulators, it could be prospective employees. Each one of those has a section they can look at that will satisfy their needs. So, for example, if you look at investors, investors will be looking at issues to do with long-term performance of your company. So, in most cases, they will do further analysis on these financial statements. The data and information is already captured in those financial statements. Now, what for each one of these stakeholders, be it investors, bankers, suppliers, and so on and so on, they will do a further analysis on these financial statements. The information is already captured in those three main financial statements we looked at. So now, most of them will start calculating what we call financial statement ratios. Financial statement ratios. And they will look at each and relevant ratio that will satisfy the information that they need to know. The information in the financial statements is not presented in ratios. It's not in ratio form. These are just bare data. It just tells you, for example, income that you make. It doesn't tell you what your turnover is, profit versus turnover, or profits versus volume of sales. Those things, you have to calculate them. It will tell you the profit you have made. It will tell you the sales volume. It will tell you the cost of sales. It will tell you the net gross profit. It doesn't tell you the ratio of profits over sales. So, for example, what we are concerned about here is the issue, for example, let me give you one example, just to make sure this thing is clear enough. You may be a company that has sales volume of 1 billion kwacha a year, and your profit is 100 million. Your sales volume was 1 billion, your profit was 100 million. Another company has sales volume of 200 million and its profit is 50 million. One company sales volume was 1 billion, profit was 100 million. Another one sales volume was 200, profit was 50 million. Can you see the difference there? Are we together?
Yes.
Aha. So which company is more profitable?
The first
second
one.
company.
Sorry?
The second one.
Yes. The first
Because,
one, it has taken sales of 1 billion kwacha for it to make 100 million profit. The other company, it has only taken sales volume of 200 million to make 50 million in profits. So the first company is struggling a lot.
I think what we are confused is that the second company just said it 200. So we're not sure that whether it is 200 million or 200 billion.
Sorry? Akim,
the
talk
second,
again, I can't
yes.
hear you.
Yes, I'm saying I think we are confused on the second company. It just
The
said
second company,
200. Yes, it just said 200.
Volume sales, total sales in a year was 200 million. The declared profit is 50. Okay? The other
Yes.
company, sales per year was 1 billion. And it has declared profit of 100 million.
Bazali, I got mute.
So you need to calculate sales versus profit. So the profit turnover volumes are different in that case. One company is struggling a lot to make profit. So let me simplify it for you. The first one, I said 1 billion to make 100 profit. So let's say the sales volume are 500 million to make 50 million profit. Another company, 200 million sales to make the same profit of 50. Which is struggling there?
The first one.
Yes. And the ratios, you calculate them yourself. So you will say profit over sales for this company, and then you find the percentage. Then you say for the second one, also profit over sales. You will see which one will have a bigger amount, bigger ratio there. So what we are saying is that these ratios, various stakeholders will calculate what ratios they want to have, they want to use for their purpose from these financial statements. So investors will use, for example, profitability ratios. Bankers, probably because they are talking about, they are interested in knowing whether a company will pay back loans. So they will be looking at liquidity ratios. Suppliers or customers will be looking at cash flows. The MRIA will be looking at the profit and loss account, so on and so on and so on. Okay? Are we together? Hello? Are you there? Hello? Hello? I don't know whether everybody is listening. Can somebody respond if you are still there?
Yes, I can hear you.
Oh, hey, yeah, you should respond. Don't keep quiet.
We are here. Kapena pake inazakhanga ya imago.
Oh, okay. Because I don't want to be talking to myself.
We can hear you, sir.
Okay. So,
I think Bazaar in the Samonega.
I'm seeing.
No, Agim, no, I can hear you. I can hear you, sir. Okay.
I just wanted to hear your voice.
Yeah,
Okay,
you.
so
Sir,
financial ratios.
let
The
me
definition of a financial ratio is the relationship between two or more. So, for example, the relationship we're talking about here, we're talking about profit versus sales volume. So it's a relationship. When we say a financial ratio, we are talking about a relationship between two or more numbers in the financial statement. The numbers, the figures in the financial statement. So you want to calculate the relationship between two or more numbers in there. And that relationship is what we call a financial ratio. So these ratios are useful dependent on the purpose of the analysis. So these financial ratios are used dependent on the purpose. They are used dependent on the purpose. And we have discussed the various stakeholders here. So each
Bazaar,
stakeholder
unmute
has a
your mic.
purpose.
Unmute your mic.
Sorry?
I'm saying Bazaar should mute his mic.
Yeah, please mute. You only unmute when you want to speak. Otherwise, we'll get background noise from your house. Okay? So, as I already said, suppliers are short-term creditors. They will supply something to you, hoping you will pay. So the ratio that they'll be looking at is something to do with short-term liquidity. Bond holders, those who want to give you a loan, a long-term loan, will also be looking at long-term liquidity ratios. So equity investors, they will also be looking at earnings per share, long-term earnings, capability of a company to make profits over a long time period. So they may actually not be looking at only one year. They might be looking at more years of study of your financial statements to see how consistent you have been making profits over the years. So these ratios are calculated based and used based on the purpose for which somebody wants to use them. Please get this very clear. So in your assignment, of course, I have seen some of you who have submitted